Chapter 4 deals with the analysis of financial statements. And our major learning objectives are first, to explain what ratio analysis is. Second, to list the 5 groups of ratios and be able to identify, calculate, and interpret the key ratios in each group. Third, discuss each ratio's relationship to the balance sheet and income statement. Then fourth, discuss why return on equity is the key ratio under management's control, how the other ratios impact return on equity, and explain how to use the DuPont equation for improving return on equity. And then fifth, to compare a firm's ratios with those of other firms, which is called benchmarking, and analyze a given firm's ratios over time, which is called trend analysis. So we're stuck with the De Leon company again with this chapter. So here's our data. Remember 2014, they have a pretty horrible year. And now we've got some new information. We've got estimates for 2015. So we're going to see how they plan on fixing the problems that they created by doing that expansion project. You can see that if you look at the balance sheet, they've made a way to increase cash, so they've improved their cash position. Their accounts receivable is going to increase, which that's not necessarily good, and their inventories are going to increase even more, which is also not good. And then if we looked at their fixed assets, it looks like they're not investing anymore because really it's gone down a little, and it's probably for depreciation purposes. And you can see the depreciation is greater for 2015. We have our total assets. If we look at liabilities and equity, how do we finance those assets? It looks like accounts payable decreases from 524 to 436. Accruals decrease. So these are some good small improvements. And notes payable decreases by $336,000, which is really good. Now, their long-term debt also decreases, down by $323,000 to $400,000. However, it looks like they've really just made an exchange, bringing down their debt levels and issuing common stock to finance that gap, because you can see their stock went from $460,000 to $1.7 million, which is just kind of crazy. But they got rid of their debt. They pretty much issued stock to replace that capital need. And then retained earnings is expected to go up because they expect to have positive net income. And if you look at their income statement, we know 2014 was a negative net income. And then 2015, they are expecting a positive net income. So it looks like they've increased their sales. Their costs and other expenses increase some, so it looks like at least they have an EBITDA, earnings before interest, taxes, depreciation, and amortization, of $609,000. And then if you look down, their interest expense is much lower, so that's probably helping them have a positive net income. And so you see how we get to the $253,000 of net income. And then we have other data. So remember, they had 100,000 shares outstanding in 2014, and now they've issued 150,000 more shares because they have like a lot of common shares outstanding and common equity on their balance sheet. Their earnings per share is expected to improve from a negative earnings per share to a positive. They expect to increase their dividends back to 22 cents for the year. And their stock price, they estimate it's going to go up to $12.17 from $2.25, which may be pretty unrealistic. And then they've kept their lease payments the same.